Hello everybody and welcome to this short video. My name is Chris Thomas. I'm a director of One Accounting. We are a chartered management accounting firm up in Edinburgh, and I hope you find this video to be of interest. Today's presentation is on something that I am calling the Entrepreneur's Tax, which was a change to the tax rules on dividends that was announced by George Osborne in July 2015. So this is going to be a big change for any of you out there that are running your own business. So the dividends tax rules are going to be reformed from the 6th of April next year, and that's going to hit any business out there that is paying its shareholders, directors with dividends. At the moment, you can actually make quite significant tax savings by paying yourself a small salary with a balance in dividends, but as I'm going to show you now, that concession has been partly withdrawn. But it's fair to say that some taxpayers out there who have perhaps a large share portfolio will actually pay less tax after these changes. So let's start off by just going through the current rules. So at the moment, a basic rate taxpayer will pay no additional tax on dividend income, and there's actually no national insurance either on dividends, which makes it a very attractive part of an individual's tax planning. If you are a higher rate taxpayer, that's to say if you would normally fit in the 40% tax bracket, you would pay tax on those dividends at 25% of the net dividend that you pay yourself. And if you are an additional rate taxpayer, which is anybody earning over £150,000 or in a 45% tax bracket rate, you would pay tax equivalent to 30.6% of the net cash dividend that you pay yourself. Now, the advantage for tax planning purposes is that you can pay dividends up to the level at which the higher rate of tax kicks in, which is $42,385, with no additional tax due. So this is highly effective tax planning for particularly family businesses where income can be spread across spouses or perhaps a brother and a sister that are involved in running a business. So you can extract dividends with no additional tax to pay. So the new rules that are going to apply from the 6th of April next year are as follows. Every individual will receive a tax-free allowance for dividends of £5,000. So this doesn't matter if you're running your own business or if you actually receive dividend income from maybe shares that you own in PLCs. The first £5,000 of dividends that you receive will be tax-free. So the change that shareholders, owner, managers, business is going to see is that above this 5k level, you'll pay tax on dividends at 7.5% if you're in the basic rate tax band. And then if you go into the additional rate, i.e. you're a higher rate 40% taxpayer, you'll pay tax at 32.5%. And if you're in the top bracket, earning over above 150,000 a year, you will pay tax at 38.1% on those dividends. So that is an increase of 7.5% across each of those bandings. So some people will do okay out of this. If your dividends are fairly small, below 5,000, you have the advantage that there's no tax on these. So I guess you've got the advantage that your tax isn't going up. So you could benefit here, as I said, if you have a share portfolio or just take small dividends from your company. But the majority of our clients who are paying substantially more dividends than £5,000 a year, unfortunately, are going to lose out. So anyone paying more than 5,000 is going to pay more tax in the 16-17 tax year as compared with the 15-16 tax year that we're currently in. So the bad news is, if you are a director shareholder paying through the traditional route, the small salary of say £8,000 a year, and then taking the balance of your remuneration in dividends up to say the 40% tax limit, then I'm afraid you're going to be paying an extra £2,000 a year in income tax. Just by comparison, if your earnings are around the 60k level, then the effect of the new dividend tax will mean that you're going to pay an extra £3,500 in tax per year. So unfortunately there's no magic bullet, there's no answer that I can give you to dramatically reduce this tax, but you can plan ahead. So what we're doing with our clients, and we'll be doing over the course of the coming months up to the end of this tax year, is look at the options for taking out dividends before the 5th of April 2016. So one option is to actually accelerate payments of dividends before the end of this tax year to avoid paying the extra 7.5%. So for some clients, it's going to be better for them to use up their basic rate band, this nil rate band, to pay dividends, pay no tax on those dividends, and effectively they've got a 7.5% win, as if they'd actually delayed paying those dividends until after the end of the tax year. And one option is that it's possible to pay dividends, take advantage of the lower tax rates, and then loan this money back to the company, and that money will sit in your director's loan account and will be available to withdraw from the company tax-free. So we'll just cover the key points. So the new rules are going to apply from the 6th of April next year. Any tax on dividends will need to be disclosed on a self-assessment tax return as income tax, and because we are talking about tax for the 16-17 tax year, the first payment of this dividend tax won't be due until the 31st of January 2018. So in terms of how it's going to hit you in the pocket, it's still a couple of years away, but we need to start planning about the changes now. So I hope this short presentation has been of use. If you've got any questions, then please do get in touch. It's Chris Thomas at One Accounting, so my email address is on the screen there, and you can also call me in the office in Edinburgh on 0131 220 0152. Thanks very much for watching.